Welcome back to The Explainer, everyone. I'm absolutely thrilled to have you here today. Look, if you're the kind of person who loves cutting through all the market noise to see exactly what makes massive global businesses tick, well, you are definitely in the right place. Today, we're pointing our corporate X-ray machine right at the undisputed heavyweight champion of the hospitality world. I'm talking about Marriott International. By tearing into their recent financial filings and looking at their strategic playbook heading into 2026, we're going to see exactly how this giant prints money, where it's expanding, and what its next big moves really are. Okay, so here's our roadmap for today's Explainer. We're going to hit 5 key areas. First, their global footprint. Second, a deep dive into their 2025 financial performance. Third, strategic growth and conversions. Fourth, how they are returning value to shareholders. And finally, number 5, the 2026 outlook. Let's get right into it.
Section 1. Global Footprint.
Now, to truly wrap our heads around Marriott's financials, we absolutely have to grasp the sheer, staggering scale of this operation. Because when you think of Marriott, you aren't just looking at one single standard hotel chain. No, you're looking at a massive umbrella that covers luxury, premium, select, and extended stay options literally all over the globe. We're talking active operations in 145 countries and territories. They are without a doubt the clear industry leader when it comes to overall size and brand breadth.
And when we say size, well, this is the number that should instantly grab your attention, nearly 1.8 million. As of early 2026, Marriott boasts almost 1.8 million rooms spread across over 9,800 properties worldwide. I mean, think about that for a second. That scale creates an immediate, massive gravitational pull across the entire travel industry.
So what does having millions of rooms actually do for them? It creates this incredibly powerful flywheel effect. Their rock-solid market position lets them expand aggressively? Sure, but the real secret weapon here? It's customer loyalty through Marriott Bonvoy. They have this absolutely massive membership base that just constantly feeds predictable, consistent demand right back into all those properties. It gives them a tremendous edge in swallowing up market share.
Section 2. 2025 Financial Performance. Okay, before we really get into the weeds on the data, let's just make sure we're on the same page with a super important piece of industry jargon. RevPAR. It stands for Revenue Per Available Room. It's a pretty simple calculation. You just multiply a hotel's average daily room rate by its occupancy rate. But in the hospitality world, this is the ultimate barometer. It tells you exactly how healthy a hotel's top-line revenue actually is.
Now here's where things get really fascinating. Look at the stark contrast in the fourth quarter of 2025. In the US and Canada, RevPAR growth was completely flat, actually dipping just a hair by negative 0.1%. But then you look at the international side and boom, it's surging, up 6.1%. This is a perfect illustration of how Marriott's immense global diversification acts as a shield. When one domestic market gets a little soft, an international market is right there, picking up the slack and driving the whole machine forward.
And because of that incredible international strength, the full-year results for 2025 were just massive. Despite that little bit of domestic softness we just talked about, global RevPAR for the entire year still ticked up by 2.0%. And that top-line bump drove some seriously impressive bottom-line results. We're looking at over $2.7 billion in adjusted net income and a jaw-dropping adjusted EBITDA of over $5.3 billion.
Section 3. Strategic Growth and Conversions.
So a great question to ask here is, how on earth are they expanding so fast without dealing with the massive delays and costs of new construction? The magic word is conversions. Basically, a conversion is when you take an existing independent hotel, or hey, even a competitor's hotel, and you completely rebrand it as a Marriott property. Why is this such a game changer? Because it allows for rapid, super capital-efficient growth. You don't have to pour a single ounce of new concrete. You don't have to wait years for local zoning boards. You just upgrade the property, slap a Marriott brand on it, and plug it right into that massive Bonvoy system.
Let's actually hear directly from the top, because CEO Anthony G. Capono really highlighted how vital this strategy is. He noted, conversions remain a key driver, contributing around a third of our signings and openings. So, they are replenishing and growing their inventory at lightning speed. And get this, 75% of those newly converted rooms start generating actual fee growth for Marriott within just 12 months of signing the deal. That is a seriously fast turnaround.
And thanks largely to that rapid conversion strategy, we arrive at this totally mind-boggling number, 610,000. By the end of 2025, Marriott's development pipeline hit a record 610,000 rooms. To put that into perspective for you, their pipeline of future rooms they haven't even opened yet is actually larger than the entire existing built portfolios of many of their competitors. It's wild.
Section 4. Returning value to shareholders. Okay, so how does all this operational success, all these rooms, actually translate into a payoff for investors? It really comes down to how management handles their capital. And clearly, they aren't just sitting on a giant pile of cash. In 2025, they returned $4.0 billion to their shareholders. But look at their projection for 2026. They are stepping on the gas, accelerating that return to more than $4.3 billion. They are making a very conscious, steady effort to increase the capital flowing right back into investors' pockets year over year.
Let's break down exactly how that money gets returned, because it generally happens in two main ways. First up, very aggressive stock buybacks. They scooped up 12.1 million shares for about $3.3 billion in 2025 alone. Second, they've been rewarding shareholders directly. They recently declared an increase to their quarterly cash dividend, bumping it up to 73 cents per share, which is payable in June 2026. Actions like that, they show an immense amount of internal confidence in their future cash flow.
Section 5. The 2026 Outlook. Let's pivot and look at what Marriott's own internal projections are telling us about the near future. For 2026, they're forecasting global RevPAR to grow another 1.5% to 2.5%. They expect net rooms growth to actually accelerate, landing somewhere between 4.5% and 5.0%. And they are projecting their adjusted EBITDA to push right up near that $6 billion mark. And honestly, they're already off to a flying start. The first quarter of 2026 showed a 4.2% jump in global RevPAR, which puts them very firmly on track to crush these targets.
But honestly, here's a wild stat that totally jumped out at me from the filings. Co-branded credit card fees are expected to jump by around 35% in 2026. Think about that. A massive chunk of Marriott's franchise fee growth isn't just coming from people sleeping in hotel beds anymore. It's coming from everyday consumer credit card spending. It really shows you just how deeply entrenched the Bonvoy ecosystem has become in consumers' daily financial lives.
Which brings us to our final thought. We've dug through the data. We've seen their aggressive conversion strategy. So, here's the big question you need to be asking yourself. With domestic U.S. growth cooling off a bit, will international market expansion and co-branded credit cards become the permanent, unstoppable twin engines powering Marriott's massive empire? It's a fascinating dynamic, and it's definitely something we'll be watching closely as 2026 unfolds. Thanks so much for joining me on this explainer, and keep learning.